If your money plan still looks like how it did 5 years ago, 2026 could be a surprise for you and maybe not in a good way. Let's go through some trends I'm seeing and go through how it's going to affect you and your money so that you are prepared and not caught off guard. That's always the key. So let's jump into trend number one. It is about money anxiety and how it is driving decision making. So I've noticed in conversations I'm having, we're not having conversations necessarily about rates of return. Now, that's also because the markets have been doing very well the last couple of years, and people don't tend to pay attention to it as much when the markets are doing well as when they are not doing well. Of course, it's just human nature. However, we're having a lot more conversations about certainty. So, about making sure that they're going to be okay in different situations. And why that is happening is people are worried about job loss, AI coming in and changing things dramatically. They're worried about the economy in general. And also, it's been a little while since we've had a market downturn, and people get a little nervous after a couple of good years. That's, again, human nature. And when I do a little bit more research, apparently searches on financial stress, cash safety, and retirement confidence, and other things like that are just on the rise. And so when people are asking these kind of questions, emotional decisions are a real risk. So they're risk to you if you make emotional decisions, because those aren't necessarily thought out decisions that are going to help your plan. But also, if you tend to be that kind of calm person that doesn't let this stuff affect you in making decisions about your money, it still can kind of creep in. You've got your friend that you talk to who's nervous about this. Then you read this article, then you hear this guy in the news, and it can kind of seep in, and you can find yourself making emotional decisions when you think that that's not the way you are. But it can still happen. You can start to feel worried about things that you know logically are not so, but you just start to kind of go with the flow essentially. And so in situations like this, the best way to make sure you don't make emotional decisions when it comes to your money is to have a plan and to make sure it is updated and to have as many scenarios as you need and to go through the risks so that you are set and you can call your person that you talk to about your financial stuff and they can say, we're good, just as a reminder, and walk you through it. And that way you are kind of talked off the ledge of making some bad decisions in the future just based off of some anxiety you're feeling. Trend number two is interest rates. Now, I'm not sure if this is a trend, but I think everybody knows interest rates are going to change dramatically in 2026. Jerome Powell's out. Whoever President Trump brings in is probably going to lower interest rates dramatically if anything follows like his first term in office. So what this does is it loosens up cash to allow people to borrow easier for businesses, for mortgages, and that's great. That promotes growth. However, what we have been enjoying the last couple of years are cash equivalents like high yield savings accounts and money market accounts and things like that. They have been getting a pretty decent yield interest rate, right? They've been actually beating inflation, which has been great. Well, that is probably going to change. And so you want to make sure you look at your cash alongside the rest of your plan and see how everything balanced out. Have those conversations now with your advisor, because what happens is when we see cash not getting the rate of return or the interest rate that we expect on it, then we start to panic and start saying, maybe I should push it in the market. Maybe I need to do this or that. And again, that emotional decision making. And so you want to create that balance now while the interest rates are still doing well so that you can prevent cash dragging down your plan, but also that emotional knee-jerk reaction of pushing it into something maybe a little too risky for what it should be for. Trend number three is AI and automation are creeping into personal finance. People do not realize this. Those robo tools, the budgeting apps, the AI advice everywhere, that is really starting to take hold. And it's helpful for organization, but it can be really dangerous when you blindly trust it. So I know a lot of people I've talked to will go on to their favorite AI tool and ask all these questions about tax or this or that. But the thing is that those tools are still only as good as what you give them. They don't know your personal situation. They don't know your timeline. They don't know your stress, your tax situation, or even your stress level, or your risk level, right? And so you want to use the tools to be a resource, but you still want to use your judgment and your resources, like maybe your advisor, to help you make those actual personalized decisions. Another area I'm starting to see that AI is starting to move into when it comes to your personal finance is on credit cards. They're starting to make suggestions of things you should buy. And I've heard that many credit cards are actually putting into place, you can turn on an AI system where they can buy for you. That's very dangerous. I would tell people, don't do that. I know it seems fun, but don't do that. That could put you in a lot of harm's way. Trend number 4 is retirement is becoming much more personalized, which I think this is fantastic. I've been definitely thinking that that's the right thing. You know, if you've ever worked with an advisor before and you feel like you're kind of put in a cookie cutter plan, like you're set in this portfolio because of your age or because of your risk profile, and everybody that kind of fits in your world kind of fits in that portfolio, you know, alongside you. Or you feel like the plan's kind of like everybody has the same plan, you know, that doesn't feel very personalized. That is all going away, which I think is great, because what we're focusing now more with clients and people I talk to are income planning, longevity, flexibility, financial freedom, really building on life decisions versus, you know, this retirement at age 65. Building in that flexibility in your plan, making it individualized, making it fit with what you're trying to do is really important. And life changes, you know, that Ferris Bueller, like life moves pretty fast. If you don't stop and look around it once in a while, you'll miss it. Life moves fast, and your plan needs to be flexible with that and really be individualized for you. And I think that that's a great trend that's happening. So the big theme of this video is to say, be prepared. Really put the time in now that the markets are doing pretty good, that the economy seems to be doing okay. You know, it depends on who you're listening to right now. And focus on things like cash flow, income sources, and stress test your plans now when it's good. That's something that I'm going to be working on this year with many people. So you don't need to predict the future. You need a plan that actually bends to the wind that happens in life. So if this was a good video for you, I hope you reach out and let me know. I'd love to hear more topics that you're looking for. We're trying to do a couple more shorter videos for you out there. And until next time, be safe out there, stay strong, be kind to one another, and we will see you on the next video. Bye-bye.